For some students, your college semester is coming to a close while others are preparing for the fall and their first semester. Whether you're a seasoned or a new student, paying for college is not easy to navigate. Stay tuned as we talk with Rich Neilsen, Lending Products and Partnerships Manager from Granite Edvance, about private loans and how they can fit into your plan for financing college tuition.
You're listening to Triangle's Making Money Personal podcast, where we engage in real talk about financial matters that affect our community. Today's episode is sponsored by Triangle Credit Union, recently voted Best Credit Union in New Hampshire.
Welcome, Rich. I'm Terry, and I've got Liz here in the studio, and we have Rich from Granite Edvance. Welcome.
Thank you for having me.
Yeah, we're excited to have you. It's always a great topic when we talk about, how to finance, for college and university and stuff like that. So we're excited about having you here today. Before we get into, loans and different types of loans and all of that, can you share a little bit about your role, about who you are and what your role is
Sure.
at Granite Edvance?
Yeah. So I'm a New Hampshire native. I grew up on the western part of New Hampshire. I had someone from New York trying to educate me that there is no western New Hampshire. I'm like, well, there's four directions, and I went as far west as you could go in New Hampshire. So to me, I get no one around here calls western New Hampshire, but to me, it was western New Hampshire. I grew up over in Claremont, went to college up in Maine, and like many people that go to college, thought that they knew what they wanted to do without having really any real understanding of what that meant. And so I worked as a tour guide for 4 years when I was in college, and so that got me into the admissions world in college recruitment. And so after I graduated with a degree in psychobiology, neurology, animal behavior, thought I was going to train SEALs and stuff like that. Didn't happen. Didn't realize what it would take to actually do that kind of work and what that meant. And so I ended up getting my first job as an admissions counselor at the University of New England. And so I worked there for 2 years, did the whole recruitment cycle, get out on the road, college fairs, high school visits. And so then my personal life kind of brought me back to New Hampshire, and I reached out to this company in Concord, at the time known as the NEEF Network, and asked if they had college counseling available, or an opening for college counseling. And so I was brought on as a college counselor in 2008. I did that for 5 years till 2013. And then in 2013, our company launched our existing private student loan program. And while I was doing the college counseling, I took a real interest in the paying for college aspect of things. So I came from the admissions background, but kind of as I was meeting with families, felt like, as important as your essay is and as important as these things are, it's really going to come down to this.
Right.
And so this is what I really focused on. And it was at a time when I was doing that there's a lot of transition in the student lending industry. A lot of lenders were leaving the market. The market in general was, 2008, the crash. And then, so you had a lot of people pulling out of the market. There weren't fixed rates available. So it was like, who is offering loans and what's the best option? How do you guide families during this process? And so I was that was my niche in that environment, was to focus on that. And so when we launched our program, I felt like I was pretty well educated on what it would take to be competitive in this space. And so I got into working for us on the student loan side in 2013. And I've done almost everything associated with our student loan product since I've been there. Minus like the bond deal finance side of things. But outside of that, I've really kind of touched everything from product development, working with online referral partners, working with our banking partners, logistics for going to a trade show. I was talking to someone the other day. I was like, I need new boxes to ship this stuff in. They're like, man, you really control everything, don't you? I'm like, well, yeah, like I need boxes that are going to get the stuff there and get it back. So we got to order new boxes. So I do a little bit of everything. But yeah, really focused currently on product development and partnerships.
Nice.
Cool.
Excellent.
So for the lending products and partnerships that you do, it sounds like this is Granite Edvance's program for private lending. Is that correct?
Correct. Yes.
Okay. So that's kind of what we wanted to bring into this whole discussion here is, college funding is like an immense topic, right?
Sure.
And like for a lot of people who are interested in learning more about it, there's obviously everyone hears about student loans, but it's further broken down from public to private, correct?
Yeah.
Sort of.
Yeah.
Yeah.
I would maybe steer away from the term public and instead federal versus private.
Oh, there you go.
When you talk
Perfect.
about private student loans.
Okay.
But yeah, it's pretty immense. And, I work in an industry that from a connotation standpoint doesn't have the best reputation. Like when people hear student loans,
Right.
there's the immediate connotation of it's debt, it's a problem, shouldn't take that on, it's bad debt. Like that's the connotation to it. And the way that I kind of phrase it, I work, Granite Edvance is a nonprofit, and the way that I kind of phrase it for people is like, we're not forcing a product on anybody, but the reality is the way that higher education in this country is funded, it's a necessity for a lot of people in order to fill that gap. And so we want to do that. And we want to do it in a responsible way. We want to educate people along the way, and we want to do it as affordably as we can for them.
Gotcha.
Yeah. One thing that I'm seeing, and it's trending or has been trending for a while, is everybody getting their acceptance letters. Like, they record them, right? So it's like, you watch these reels and these kids have applied, and so they'll open up their package or they'll look online. It's usually online now, right? And then they start squealing. It's like, oh, they got in. But for the parents, I feel like that it's more important to see what the financial aid package is going to be, right? It's like, okay, now that you got in.
They don't record that part of it.
Right, yeah.
No, because that would be parents crying. That's why, we always want to focus on the positive aspect of it. But, yeah. So can you talk a little bit about just give us a little bit of information about like the private student loan sector then and how that works?
Sure. So, funny you just mentioned this, like getting that financial aid award letter, that's when it really kind of starts the wheels turning for everyone, right? So they know how much they're going to get from the college. That financial aid award letter typically is going to include federal student loans as part of that award letter. So before you ever get to what's the remaining balance, what do I still owe to this school this fall in order to show up, they've already been packaged with a certain amount of federal student loans. And there's allotments for what level they are in college. And then they get to what's left over and how are they going to finance that. Okay. And there's a federal option, the federal plus loan, parent loan for undergraduate students. There's private student loans. And then there's the outside of student lending that people utilize. People will utilize second mortgages on their home. People will utilize borrowing against retirement accounts. People will utilize payment plans with the college. So there's a number of different ways that they do it. And tax implications, a whole lot of things. So what we really specialize in is if you're funding it through student financing, these are the two main ways. So when you think about a student borrowing a loan, there's the federal government's program that they'll get as part of their financial aid package. If the parents want to borrow a federal plus loan, that's also part of the federal government's direct lending program. And then there's the private student loan, which is like, I don't want to use the word competitor, but it competes with the plus loan. So you're doing one or the other. You're not, you wouldn't find typical scenarios where someone's borrowing a plus loan and doing a private student loan.
Oh, okay.
You're typically going to do one or the other. Key difference between the two of those, there's a number of differences, but to me, the key difference, if you're the parent and you're going to take out the plus loan, that loan is your debt, the parent's debt for the life of that loan.
Right.
The private student loan, what you're going to find is that in the majority of circumstances, the parent or somebody is going to need to co-sign for that student, majority of circumstances. The difference being that there is the potential in most programs, not every single private student loan, but in most, that parent could be released as a co-signer after certain conditions have been met on that loan. Certain payment conditions, the borrower meeting approved credit and income thresholds, then the parent can be released, and now they're no longer associated with that debt.
Gotcha.
Versus the parent loan, it's with them for the life of it.
Yep.
There's other nuances to these programs, but that is one huge difference. Because people say, well, I don't want to co-sign. I'm going to do the parent loan. It's like, well, might in fact be more.
You might be taking it all on yourself,
a lot more
right?
risk for yourself than co-signing it. So. And a lot of people aren't even familiar necessarily what co-signing means, surprisingly.
Yeah. Right.
That co-signing, it's equal liability. It's going to show up on your credit report. Same, it's going to show up on your student's credit report until such a time that you could be released. So co-signer releases are popular benefit programs to be looked at because, again, some won't offer them. Some it will be a minimum of 4 years of continuous on-time payments. Other ones might be 36. So for example, for our program, it's 24 consecutive on-time payments, but then you'll see that there are certain states that might require you to release a cosigner even before that.
Okay.
So lenders are going to follow whatever those state guidelines are. And if the state hasn't set some minimum, some threshold, then it's whatever one the lender has set themselves.
Okay.
So yeah, that's a key benefit to look at when comparing different private loan options.
Okay.
I would say.
So I still have I have a college student. She's actually going into her senior year. She's actually mid-semester right now, so she has one semester left. So just in terms of, so I've been doing this for 8 years and I still don't understand it. So, I'm so glad you're here, Rich, honestly. Learn from my mistakes, parents. Listen to me. Okay, so just in terms of the FAFSA, the reason why you do the FAFSA is that to determine your federal lending options and, you know, what you get for...
Yeah, so first think of it as a qualifier.
Okay.
If you don't file the FAFSA, you will receive no federal financial aid.
Okay.
Then go beyond that, and the output of that FAFSA information is going to allow the school to know from an institutional standpoint how much money they're going to package for you.
Gotcha.
That's the baseline form. Typically, you might find that the higher selective colleges will use an additional form, the CSS profile, where it digs even deeper because they're using what they would call an institutional methodology to determine how much they think that you can afford.
Right.
And so the FAFSA had some changes recently. It used to be that it calculated your expected family contribution. So it was like, oh, this is $1. They expect me to contribute $14,000. And now that's changed to what they call the SAI, the Student Aid Index. And so it is not a number, a dollar number. It's like a qualifying number to see if you qualify for Pell Grants and those sorts of things.
All right.
So it's a little bit different in terms of how it operates now than what it used to.
Yep.
That's a recent change. But yeah, I would tell every family that I've ever met with, counseling and otherwise, that said, you know, I'm not going to file that. I'm not going to file that FAFSA. We're not going to be eligible for anything. Everyone is eligible for the federal student loan. So unless your plan is that you have a nest egg of money to pay for all 4 years of your child to go to school, you should file the FAFSA.
Right.
Because if you don't have that nest egg to pay for it out of pocket, then you're going to borrow in some fashion.
Right.
The best way to borrow for school, in my opinion, is baseline the federal loans that are offered as part of the financial aid package.
Right.
So maximize those before you start getting into private student loans, parent loans, or any other secondary market like mortgages or retirements. So.
Okay, so far we're pretty good, Rich. This is all good news to somebody who doesn't know what she's doing. Right, all good news. So, and then the other thing that you touched upon, which I don't know if a lot of listeners understand this because I didn't either, but it does seem to me that my daughter gets higher. I don't know if it's higher rewards or higher. She's eligible for more funding as she's gotten closer to her senior year. Like, is that how it traditionally goes? Is that you do get more? Either you get more in terms from like what you're eligible for?
So the federal loans will increase. They increase each year except between junior and senior year. So they increase from freshman to sophomore year, then they increase from sophomore to junior, and then from junior and senior they remain the same. Okay. That's how it is currently. There's a lot going on in government right now, so I don't want to speak for what this is going to look like in a few years.
Next month, right?
But those might be the increases that you're seeing.
Yep,
it could be that there's just any sort of dynamic that has changed in the financial makeup of the household. Right. That has the school saying, okay, so the need for this family has changed. The need is now greater. And so we're going to offset that with additional work study funds, additional grant funds, whatever that may be.
Okay. Honestly, it actually has it reversed for us, which was fortunate. I'm not really entirely sure. I guess I may have to go back and look at what we filed with FAFSA, like, you know, because I know that it goes back. You always report on prior year earnings, right?
Prior year.
Yeah, so I'll have to go back and check.
That could also be another factor, is that your child may have been going through when there was a change from using the prior year's tax return to using prior year's tax return. So there's a chance that you use the same taxes twice when they were in. Okay. So yeah, a couple different variables maybe playing in.
Awesome. And then just in terms of, you know, like the structure that you've laid out, do you require the FAFSA? Like, does your organization, when it looks at the potential for a student loan or somebody who's eligible for a student loan, do you take that into consideration?
We don't require it.
Okay.
We highly encourage it.
Yeah.
We certainly encourage students to maximize federal eligibility before they start going down that path.
Yeah.
But it's not a requirement for us.
Okay. All right.
And I would say that institutions also have their own policies. So it might be that junior is going to a school and that school says, in order for us to certify this private loan, you need to complete the FAFSA first.
Yeah.
You need to maximize this aid eligibility before we certify this loan that's coming through, because if we can certify it for less than what you're going to need, we'd like to be able to do that for you.
Right.
So sometimes we'll send loans to a school and we're waiting for them to get certified by the school. The certification is this process where they tell us, yes, they're borrowing within the guidelines of your rules, within the cost of attendance, and they're enrolled at least half-time, whatever our guidelines are. And so, during that certification process, sometimes there are loans that kind of hang out there and you're waiting on what it is. And so you reach out to the school and they'll say, oh, we're waiting for them to complete this form that acknowledges that they are, foregoing this aid in lieu of this and different things like that. So there's lender policies and then there's institutional policies as well. So.
All right. Great.
Can you share a little bit about like the eligibility criteria for the Granite Edvance loans?
Yeah. So I'll speak specifically about our Granite Edvance student loan. We have another product name, Edvance. That's what the product was named for a long time. And then when we renamed as a company in late 2023, our program that is specific for New Hampshire residents or students attending college in New Hampshire, we renamed the Granite Edvance student loan. We still maintain the Invest in You for our non-New Hampshire families, but I'll speak specifically about the GE loan. So you need to be enrolled at least half-time at a Title IV degree granting institution, so based in the U.S. So what does that mean? You're a New Hampshire student and you're going to go to school at a Title IV school that offers U.S. federal financial aid over in England. We are not going to lend because we will not send funds internationally.
Okay.
Even in Canada, there's a number of schools in Canada, a number of schools over in Europe that are Title IV eligible, but we will not send funds internationally. So the other key thing is they need to be enrolled at least half-time. The school has to be degree granting. They don't have to be in a degree program. So what does that mean? Student is a post-grad student getting a teacher certification. So they've already completed a bachelor's degree. They want to get certified to teach. So they're doing that program through a school. School needs to be degree granting, but it's not a degree program. That's fine. They just need to be taking enough credits to be considered at least half-time, and that makes them eligible. Yep. The other popular thing is that you might find students lose eligibility for federal aid due to satisfactory academic progress. They have to be making progress. Yeah. And so that can impact federal aid eligibility. So a popular question from schools when they're deciding what lenders they're going to work with is whether or not you require satisfactory academic progress. We do not require that. We know that losing funding is going to be one of the largest barriers to persistence. Mm-hmm. So if you're struggling, we're not looking to find another way to make it harder for you to continue to persist. Mm-hmm. So we want funding to be available there. So we don't require satisfactory academic progress. But for the GE program, well, I said they need to be a resident of New Hampshire or attending college in New Hampshire for that program. And it worked. I mean, I would say not the vast majority, but the majority, more than 50%, are New Hampshire residents in that program. And then we obviously have the ones because, different schools in New Hampshire have us on their lender list. So kids that are coming to UNH from Maine see us on the list, see our competitive rates, and apply. Yeah. What I would say about our company is we're unique in the country. We're not necessarily unique in New England. And so, and what I mean by that is a nonprofit agency that has a student loan program, that in and of itself is somewhat unique. I looked at this the other day because I was down in Virginia and I was talking with some folks from George Mason University, and they're like, a nonprofit lender? Never heard of that. And so it's like, well, let me tell you kind of what that means. It's like, the term I use to describe it is like full cycle lending, right? So student goes to a high school presentation and we are the people there hosting this presentation about college planning, all this. And then they hear that they can come and meet with us and they can have an appointment and get essay help. They can get FAFSA help. They can have someone review their award letter and make suggestions on where they can go for funding, these sorts of things. All at no cost to them. And then it comes to the time they need to get a loan. Potentially that family takes a loan with us. There's interest that is paid on that loan. Goes to a lot of that interest goes to just a simple act of facilitating that loan happening, which
100%.
is a big thing that people don't understand. You guys work in this world, so you get it. A lot of those families don't understand the rates on these things are what they are because of what it costs to offer these products.
Right.
And so, but there's interest, there's revenue there. But as a nonprofit, that revenue is then what is reinvested into us being able to do the nonprofit work that we do within the community. So that is what is paying the college counselor to be there. That is what is paying for the print publications. That is what is paying for the scholarship program that we're offering. That's what paying for the emergency grants that we're doing at the university system and community college system. So, and it's like, this is what it is. So you as a borrower, maybe you are, or maybe you are not, a direct recipient of that nonprofit work and benefit. But by nature of borrowing with us, it cycles back into the greater community for that benefit. And so as I was explaining, they're like, wow, that's great. I wish we had something like that. And it's like, no, Virginia doesn't have it. A lot of states might have a state grant program that is run by some state agency or something like that. And that's all that it is.
Just a grant program.
Right. There's no one out
resources.
there's no one out doing the community work. There's no lending component to it. And so I think it's like less than half the country have states that have a program like us. Then you go even further, and we're unique in that we offer our products beyond just New Hampshire. Like I said, we have this Invest in You product where if you're a resident of Maine going to college in Maine, we got a product for you as well.
Nice.
And the benefits from that product, just like the Granite Edvance loan, are going to be used right back here. So leverage our expansion across the country so that we can do more in New Hampshire. And as that grows, the more we can do for people in our own state. You might find other states have a program. There is nothing beyond lending in their own state. So we're kind of unique in that way.
That's awesome. I love that.
I had no idea that it worked like that's pretty cool.
Yeah.
It's like if you're gonna be paying your interest towards something, you might as well be paying it towards an institution that puts it all right back in, right?
100%.
Right.
Cool.
Just one more question, Rich, before we take a break. But you had mentioned we had a quick conversation about the co-signing, and so we wanted to know, like, when does someone need a co-signer for a private?
Very, very popular question. And I would say there's two types of students, right? Because the guidelines to be eligible for a private student loan are there's subtle nuances, but for the main part, they're pretty similar across lenders. There's going to be minimum FICO score thresholds. There's going to be minimum income thresholds. So if it is your high school student graduating, then proceeding into college, they're probably not going to meet the income thresholds, more than likely, based upon the W-2s I've seen from high school students. They're not going to meet it. And they're not going to have an established enough credit score to be eligible on their own. So they're going to need a cosigner. Okay. Our program, for example, the thresholds, if you apply without a cosigner on the credit score basis, are higher. The income's the same. The income threshold's the same. But the credit score thresholds are higher than if you apply with a cosigner and what the cosigner needs for a credit score. But to give you some perspective, and I don't want to represent that as being true of all lenders that do it that way, but that's how it is for us. But to give you perspective, across the industry, what you'll typically find is that from a credit score standpoint, you're usually looking in the mid 600s as the baseline for eligibility. And then it can go up a little bit from there, but that's typically the baseline. And then from an income threshold, usually you're at least 20,000 or more to be eligible, if those are the two criteria. There's some nuanced companies that are trying to break into like we have no cosign required loans. And then you find out like, well, that's only for students that are in their junior and senior year in these particular programs because they have high graduation and job placement rates. So it's like, they're not really lending to the masses. But the lenders that are really kind of out there for everyone to try to apply for, that's typically what you're looking for. We ourselves, like I said, we're in that mid to high 600 threshold for a cosigner, and then our income threshold is a minimum of 30,000.
Okay. And okay, and I do have one more question before we go to break. So in terms of the GE and what was the other
The Invest in You.
Invest in You, are those like what do I want to say interest deferred until you graduate, or as soon as you take those out and you release the funds to
Sure.
the institution, are you starting to accrue interest?
Sure, that's a great question, and it's one of the benefit. Like, so we talked earlier about like cosigner release is one of those benefits that you want to look at and look at the differences between what companies would be offering. Customizability is a big thing between lenders, and what are your options. So, for example, for the GE and Invest in You, they're both set up the same way in this regard. There's 3 repayment options. So there's fully deferred. So the student goes to school, they defer everything, while being hopefully fully aware that the interest is accruing on that loan as soon as it disperses.
Right. Okay.
And that's one of the things that has come up recently with this reconciliation bill related to federal loans, which we can talk about if we have time. But interest will accrue while they are in school. The second option is interest only payments while they're in school. So the loan goes out the door to the school, interest starts accruing, you start making payments on that interest, so that when the student gets out, it's just the original principal balance that remains.
Okay.
And then there is immediate repayment. Loan goes out the door, you start making payments on full principal and interest payments while the student is enrolled. And so when they graduate, it's lower than what they even borrowed to begin with.
Okay.
Benefits to doing so, at least for our program, there's interest rate benefits. So if you choose an immediate repayment versus an interest-only repayment, you're typically going to be getting a lower interest rate offered
Right.
to
Okay.
incentivize you to take that faster repayment.
Yep.
We offer 3 terms, so you have the option of a 7, 10, or a 15-year repayment term. Those can impact your interest rate. So there's a whole matrix
Right,
of what your
right.
interest rate could be. The nice thing is that the student sees what all these things are before they actually make an election.
Right. Right.
So they know, okay, there's a difference of 1 percentage point here in interest rate if I want 15 years deferred versus 7 immediate.
Right.
And what that trade-off is in monthly payment, what it is in total cost of loan,
Yep.
so that they're aware of what they're choosing to do. There will be differences between other lenders. So in this private lending space of nonprofit and for-profit lenders, we're unique in the nonprofit space that we have that many options. Most nonprofits, the way that they approach it is everyone gets this rate. This is the set rate. It's because of how they fund. It's how they fund their
Right,
programs.
right,
They fund them at a certain rate, and so this is the rate that gives us the margin we need. So everyone gets this rate. We fund them a little bit differently than some of those other companies do. So how we set up our program from the customizability standpoint is more similar to how the proprietary sector does it, but we do it with rates that are more in unison with nonprofit companies. So,
great.
We live. Usually our rate spread from low to high is living kind of in that bottom half of what proprietary lenders are at. And then if you look at what that nonprofit that says we only have one rate, that's typically somewhere in the middle of where our rates are.
Yep.
So we're like I said before, like we're pretty unique, not only in the whole give back to the community thing, but also in how our program is structured.
Yeah, that's wonderful. And it sounds like that it really, whatever fits your budget or whatever could maybe
Right.
even fit your parents if they're even, paying
Yep.
on it for at the
Yep.
time or whatever. That's
There's
great.
a lot more to work with.
Yeah.
Absolutely.
Yeah. At this time, we'll take a quick break.
In southern New Hampshire, experience matters. For over 30 years, New England Royal Service has been the locally owned name businesses trust for exceptional cleaning and maintenance. From commercial offices to industrial sites and specialized solutions for property managers and condos, their experienced team delivers quality you can count on. Get the royal treatment from New England Royal Service. Explore their services at neroyal.com. That's neroyal.com.
Well, welcome back. Welcome back. Okay, so just in this segment, we had a few more questions for you, Rich. So can you give us some pros and cons of private student loans? Like, do you have a traditional that you would typically be able
Yeah.
to?
So what I would say is with private student loans, like I said, you go back to the 2008, 2010 timeframe, like that window, private student loans are really tough. You couldn't find fixed rates. Everything was variable, not very many lenders. And over the past more than a decade, that is totally transitioned. There's more lenders back in the market. The competition is greater, which is good for consumers. And so on the pro side of it, where I was talking about the plus loan, that plus loan has only kind of really increased in cost over time. And that's a set rate. Every parent that applies for a plus loan, if they're eligible, they all get the same rate. And that rate has been continually going up. And so what you'll find is that if you are a family that has decent credit, for us, your income amount doesn't make a difference. It's just, the income is just a qualifier. So if you have a decent credit score, you very well, and if you're willing to do immediate repayment, you certainly can end up with a rate that is far more competitive than what that federal plus loan can be. So they can be more affordable. There's been a long-standing argument about private loans and how expensive they are relative to borrowing the plus loan, and that should be stopped because there's a big group of people that can be saving money by going with a private lender on either a shorter term, immediate repayment, just to have good enough credit where they're getting rates that are several percentage points below what they'd be getting if they just simply took the plus loan. So that's one of the pros. The other pro, particularly if you have a nonprofit available, wherever your audience is listening, look at those nonprofits because those benefits do go back out into your community.
Yeah.
And so if you like having think about if you like having the ability to go and hear from experts at your high school about the FAFSA because you feel like you're not educated about it, you want to hear from somebody, and you like having the ability to get free college counseling, that has to come
That's
from
a benefit,
somewhere.
absolutely.
And so, I was talking to my colleague yesterday where it's like, you may not be the direct benefit of something, but knowing that there is a benefit happening is usually good enough for people,
Right.
to know that it's there. And so again, you may not be the direct recipient of it, but know that by borrowing with a nonprofit, the good is happening for people around you. So those are the two probably big pros that I would say in the private market.
Okay.
The cons, and I don't know if it's necessarily they're not unique. There can be so much variety with private lenders, so you can't say, one of the cons is that there's not good deferment or forbearance options if someone comes into hardship. Well, that may not be true of every lender. It might be true for 70% of the lenders, but there might be other ones where, the benefits of those are equal to what the federal loans are. So it really varies. I think a con, I understand why it's necessary, but it's a con I would say is the need for the cosigner. I don't want to say second cosigner, for the cosigner in general, because now you have two people on the debt. It's like double. It's like if you think of credit reports and someone borrows $25,000, now there's basically $50,000 out there being reported to credit card to credit reporting companies. 25 here, 25 there. It's the same debt, but now it's on both of them, not just one, which is different from federal loan debt. But and then in terms of borrowing in general, it's uncollateralized debt. So, those bankruptcy protections, I'm not an expert. I'm not a lawyer by any means. So I don't even say like, you can't discharge them. Like there's nuances there that can allow for those sorts of things, but it's not like other debt that can just be wiped out in bankruptcy.
Right.
And so those protections are limited in that way. And again, we don't celebrate that, but there are ways, these are uncollateralized loans that we have to kind of have protections on the back end as a lender as well. And so that's probably one of the things that I would say as a con. And then it's not the product. It's how much college costs in general, and how much, because they are available doesn't necessarily mean it's right to borrow that amount, right? And so we try to educate people that, sure, you have access to this money. You could borrow $140,000, but does it really make sense for you to do that given what your career aspirations are?
Right.
And those are tough decisions that a lot of families have to make. That's not a result of private or federal funding. But having, and we have borrowing caps, but I mean our aggregate borrowing limit is $200,000. So I mean that's a lot of money for someone if they're going to go and be like, I changed my major after freshman year, and psychology seemed fun. It's like,
Yeah.
well, I hope you have some plan, because
Right.
it's a lot of debt to take on, and so
Right.
you just have to be cognizant of those sorts of things. But because we allowed people to borrow up to the cost of attendance minus any aid received, people reach a point far into the game of where they want to go.
Mm-hmm.
Yeah.
And then they start thinking about how they're going to pay for it. And it's no longer about, does it make sense? It's about, can I just get the money?
Mm-hmm.
And okay, we approved you for the money. Again, doesn't necessarily make it, but that's how on the back end you end up with this bad reputation
Right.
for this
Yeah.
Right.
for this lending class, is because there's so much debt out there. But
Exactly. Yep. That's good. Thank
Yeah.
you. Thank you for that.
Are a lot of private loans, and feel free to say you don't want to answer this, but like are
On mic.
I like where this is going.
I'm just like, I don't know if we can bring, like, are they adjustable rates? Are they fixed rates? Like
Sure.
these private loans, are they something that might change?
It is incredibly it's like you almost know what's happening with our program tomorrow. So
Insider trading.
yeah, so the majority of lenders have fixed and variable rates possible. You won't find those sorts of things like in the mortgage industry where it's fixed for a certain amount of time and then they become variable. It's like they're either fixed or variable out the gate. Most lenders offering both options. So, right when we launched the program up through today, the person saw both options. And so what we're actually doing, and right now, because of what's the market conditions of what variable rates are right now,
Right.
our variable rates have not been lower than our fixed rates in quite some time. So no one's borrowing variable rates. But we have all the maintenance effort of maintaining variable rates and updating websites and all this sort of stuff. So we just decided we're eliminating our variable rates. And it actually goes into effect tomorrow morning. So it's funny you asked that question with no prompting on my
Rich is like, what do you know, Liz? What do you know?
Wow, words made it out. And so, and I think that also brings us more in line with a lot of the other nonprofits. Most of the nonprofit agencies similar to us don't do variable rates. They only do fixed. We were kind of one of the few, if not the only one, that had fixed and variable. And there was a time when variable could have been lower for you. Then if you were wise enough to know when rates are going up, then you could have refinanced your loan and done that. But right now it's not a great time for them. We don't think that they're great. Just the variability in what's happening. So yeah, we're moving to a fixed rate only, but both are available in the wider market.
Yeah. Okay.
Good. I know you have covered a lot just in terms of, the private but do you have like a few key considerations that people should think about before they choose to borrow a private loan?
Yeah, certainly what I just talked about, the total amount that you're going to need, thinking about things and in terms of longevity of your program. So what I mean by that is it's not about, can I get this loan for this freshman year and how much does that cost me? It's, if I do this freshman year and then I need to go 3 more years, and let's assume nothing changes, let's keep adding this debt.
Yeah.
While also being aware that in your financial aid package that you've already agreed to, you are also accumulating upwards typically of $30,000 in student loan debt. So put that on top of it. Now do things still make sense to you? That is the baseline thing of what should be considered before ever getting into shopping around for the right lender or something like that. Is just overall, what I tell people is that consideration should be happening in advance of the school search process, because kids fall in love with schools, parents fall in love with their kid falling in love with the school.
Yes.
Sometimes the parent falls in love with the school too,
Yes.
which doesn't help.
It does.
But
That happens.
it becomes very difficult once that decision's made to back out because of finances. Because like I said, then it just becomes, how do we get the money?
Right.
And we'll figure it all out later.
Right.
And this belief that, well, the income will be there on the back end. And, well, if it's not,
Borrowing against your tomorrow, right?
Right.
Yeah.
yes. And so that's definitely one of the things that I would recommend. Those considerations that, again, like some of the things we already talked about, the customizability is a big one. Finding products that work for your particular circumstance instead of just a one size fits all. This is what it is.
Yep.
Being able to pay anything towards the loan when they're in school is great. One factor, if you can find out from a lender what their capitalization policies are on their loans. So our loan operates the same way kind of like the federal government does in regards to this. So you borrow the loan, if you don't pay the interest on it, it's deferred while you're in school. And then there's usually a grace period. Ours matches the federal government, 6 months grace period. And then any interest that is capitalized that has not been paid, any interest that accrues that has not been paid, then capitalizes, which means that the interest is now added to your principal balance. And now the interest from that point forward is accruing on that new principal balance. Mm-hmm. So up until that point, interest is not accruing on top of interest. Right. Interest is only accruing on that borrowed amount. But once the capitalization happens, now the interest is accruing on that new principal balance. Mm-hmm. That's how our program operates. That's how the federal government's program operates. That may not be true of every lender. Other lenders might have interest accruing on top of interest from the get-go. Right. And so you'd want to know what those capitalization policies are. How often do they capitalize quarterly, monthly, how they do it. So ours is just when you enter repayment, and if you come out of any, like if you go into a hardship deferment and interest accrues during that deferment, then there'd be a capitalization when you come out of deferment. Okay. So those are key things that I would look at. Again, the cosigner release policies, reputations, longevity in the market, I think matters.
Sure.
You know, we're a company. We've been around. We've been around since the 60s. We've been around a long time, and we've been in scenarios where we were lending, and then it's just like we couldn't do it anymore based upon the market. And like 2013, we launched this kind of new. We've been lending since 2013 under this new program. Lenders come into the market, and you'll see them. You're like, wow, that's really innovative what they're doing. And people in the market sit there and we say, yeah, that's going to come full circle. As soon as that goes into repayment, defaults are going to go up on it. It's going to be risky. Defaults are going to be high. They're not going to get the investors. People aren't going to buy the bonds, whatever they got to do to finance the next round of lending. And that lender's going to go away. And your loan's going to get sold off to somebody that you're not going to have any say in. So longevity in the marketplace to me matters. Your reputation matters in that industry. So those are things that I look at. So if it's some new lender that's coming around doing something new that like
sounds amazing,
it does.
Sounds
and you know what, if you were in a scenario where you said, well, every other lender's denied me, they're the only one that approved me, then maybe it's all right, then I guess you got to do what you got to do, sort of thing. But usually if that's the case, there's some reason why that's happening. Right. Most lenders for the most part are pretty similar in terms of what the requirements are going to be for you. So
Yeah, I'm hearing a couple things. I'm hearing like know how the loan works before going for it,
100%.
Right? Like understand it, which I'm assuming comes with ask a lot of questions, right?
Yep.
Talk to someone, sit down, have a conversation. Know the lender that you're borrowing from. That's all stuff I think people could definitely.
And I would add to your first statement. Talk to qualified people
Good point.
About these things because it's an industry that people have a lot of assumptions about, and I've heard some wild things from people, and because of their own scenario and the lens that they've looked at it through, they believe X, Y, and Z about something, and then they share that as being kind of the industry method, industry standard, whatever it is, and it's completely untrue. And so, you know, that's why I love the fact that we do this the free counseling with families. So, you know, if someone wants to come in and say like, hey, I have these offers, they can sit with one of our funding specialists and they'll sit there and look at what the offers are and give them unbiased, the real advice, the real information. So.
Right.
Going back to the process, right? Do you recommend, I know you said like have an idea ahead of time, like before you even apply, right? The same, like with the private loans, I can imagine like it'd probably be best to do all the homework before you finish the application and the FAFSA and all that. So when the student gets their acceptance letter and they find out that there's extra money that needs to be borrowed, then you're ready. Like you already have the prep for it, right? So you're not like scrambling, I guess.
So I typically tell like a family, do that kind of overarching review of your eligibility of, are we eligible to co-sign or borrow? And if you're like, yep, we haven't filed bankruptcy, we haven't had delinquencies, our payments are on time, our credit, like we just pulled our credit report, everything looks good there. We got our credit score. It looks like this. Like we should be fine to borrow if we need to borrow, or cosign if we need to cosign. Okay, good. That's the first step. Then there's the step of, okay, and when we get to the point of getting an award letter, or in the the financial aid award letter, that assessment of, now, is this an appropriate amount for us to be borrowing? But there's that whole process of like looking at different colleges that are more need-based versus merit-based, that you might get more money from this type of school than this type of school given on your particular scenario. Right. You might have a high-achieving student that comes from a low-income family. Apply to need-based financial aid institutions where you're going to get more money.
Right.
And in turn, if you are a higher income family and your student is your 3.2 student, like you need to be looking at merit-based institutions, because you're probably not going to get a whole lot by way of grants from an institution.
Right.
So you need to find that school that's looking to recruit kids and willing to give discount rates via scholarship to get them there. That's where you're going to see more free money. But yeah, then that it kind of rolls in that process. So giving a timeline to this, start that review of your kind of credit background like a year in advance, summer before they're going into senior year. Talking as if seniors in high school are the only ones that go to college. Not true, but as an example. I do that even fully well knowing that the majority of college students now are like 25 or something like that. They're
like gap years and stuff, right?
Yeah. And because online's so big now, you have so many adults that are in that count. But in your typical high school student, so start it a year in advance. Do that credit thing. Keep your credit clean going into that final year as well. And then typically you're going to start that search, looking at what lenders are available, kind of getting ready for that in like that May, June timeframe. Peak season for student lending, going into a student going in the fall, peak lending season is anything from late June to like the second week of August. If you wait to the second week of August to apply, you're really putting pressure on. If you're financing, so they'll all get a bill typically in July. That bill is for the fall, and then they'll get a bill for the spring, typically in like November, December. Before you ever get the bill for the spring, the majority of people, but I've noticed people don't do this, you want to borrow. I would recommend, so I shouldn't say you need to or you should, like my opinion would be you borrow the amount you need for the year. So whatever you need for fall, basically double that, and that's typically what you're going to need for the spring. The reason for that is if you don't do that, you're going to have a hard credit pull in order to get your money in the summer, and then you're going to have a hard credit pull again to get your money in the spring.
Yep.
You also may not get the same interest rate. You may not be eligible again, whatever it may be. So when you're eligible, take what you need and do it then. Yep. So typically you're doing that in like that July timeframe. The reason why I say that is because you then have a process where it's going to take typically around 2 weeks before the school even gets notified. This is true for our program. There are documents that are going to need to be uploaded to their account. Income verification documents, could need ID documentation, different things. There's a document review time period. And then the process has to go for certification. There's forms that need to be digitally signed, and sometimes DocuSign will not make the connection between who you are and who you're saying you are. So, okay, now you got to wet sign it, and you got to scan it into your thing. So there's just these variables that can happen for any family at any given time that extend things out. And so when you wait until late in August to do it, and you're saying the school needs my money, they're supposed to be showing up next, like there's certain things we can't make go faster.
Right.
Like we have to give you a 3-day right to cancel period.
Yeah.
And we can't waive it. Like it's got to happen. And then the loan needs to get batched into a disbursement batch to the school, and they only want disbursements on this day, like whatever it is. But one of the key things that I will say is when you get the bill, there's a due date on it. If you're borrowing a private student loan, the due date is when the school wants to receive their certification by. So if it says August 1st, you're doing all that prep, you're applying for the loan, you're uploading your documents, you're making your decisions, you're signing your prom note, so that certification can go out to the school on that day or before that day. If you're not borrowing the private student loan and you're going to do a payment plan, you need the payment plan established with that school by that date. Okay. If you're doing one of those unconventional methods of borrowing against retirement, something like that, where the funds are going to you and not to the institution, then they want the money from you by that day. Because basically that's the day that they want to know that payment is in place.
Right.
Okay.
We won't disperse the funds on that day. During the certification process, the school says we want funds on this date, and then a second disbursement in January 4th. And so we send whatever they want sent on that first disbursement, and then the rest of the money is held until that next disbursement. Interest will not accrue, and I think might be a thing that scares some families. Interest doesn't accrue on that second disbursement until that disbursement goes out. Okay. So if it's a $10,000 loan, we send $5.
Right.
Interest starts accruing on that first $5.
Right.
But it won't start accruing the next $5 until that second disbursement happens, and then it's that full amount.
Right.
So there's really no downfall. Even if you go for a semester, then withdraw.
Right.
The second disbursement just gets canceled.
Right.
So there's no downside to borrowing the full amount that you need up front.
Right.
And if for some reason you felt like something so much better happened with your credit that like, well, now I'm going to get a better rate. Okay, then cancel the second disbursement, apply for a new loan for spring.
Yep.
Like you always have that option.
Exactly.
But don't put yourself in a scenario from the very beginning where you're obligating yourself to multiple credit pulls, because it's going to ding your credit, just brings your credit down, which is going to impact your pricing potentially. So.
Right.
Yep.
Exactly. So in terms of this whole process, are people do they apply online? Is that their first step?
Yeah.
Okay.
Yeah. We don't have any paper applications.
Yep.
So people are either doing it online or they can call us and one of our representatives will do it over the phone with them, where our representative reads off all the questions and enters the information into the application themselves. Okay. But yeah, goodness, I'm not even sure. I mean, it feels like every company now is.
Everything's online.
I feel like you go to any, if a bank had one, I don't feel like you'd go into their branch and be like, okay, give me your paper loan application.
No,
for this.
Everything is online.
Right,
really.
right.
Yeah.
How long would you say it would take someone to fill out this application?
So I'll break it into two parts. So our process, you start the application, and we have what's called find my rate. So the first 10 or so questions takes you about 3 minutes. It's going to do a soft pull on you. That's going to give us, if it can return rates, then it means you've met that threshold. So unless you're lying about what your income is or something like that, if you're seeing rates return to you, it means that you're eligible. We won't deny anyone on a soft pull. However, if rates are not being returned to you, it's probably an indicator that your credit score is not high enough or something like that. Yeah. And they can add a cosigner as part of that process. So how long does it take? You can know within 3 to 5 minutes and have a pretty good feeling whether or not you're eligible for the product or not. Because if you see rates, you're probably good. If you don't see rates, probably not. Can't absolutely tell you that you're not, but because there can be other variables. But in most circumstances, it's because you haven't met the eligibility criteria. And then it asks you if you want to proceed. So then if you want to proceed from there, then it goes and asks the remaining questions as part of the applications. And so the application standpoint, I would say, is about 20 to 30 minutes, maybe, from soft pull all the way through.
Okay.
But then it's like, if you're a first year student and there's no credit profile to verify identity against, then you kind of go into this gray status where we need to verify ID before we can show you what your interest rate offers are going to be. And so then it's okay. So we do a lot of reach out, scan your driver's license or ID, put it in there. Okay, verify your ID. Okay, now you're in this next stage. So we're kind of hand-holding people as they go through each of these stages of loan configuration. Now you see all your offers. Select which one you would like. Oh, I want this one. Okay, now you're past that stage. Now we need you to go in, and your promissory note is available to you. We need you to sign your promissory note and sign self-certification form. Oh, I tried to do it digitally. It didn't work. Okay, so there's, again, these variables. So on average, from beginning you started to certifications out the door, on average it's 2 weeks. If you're a returning borrower, it's probably a little shorter because we know that IDs are going to be verified, those sorts of things. So it might be like a week time frame instead. So
cool.
But yeah, that's a general time frame.
Cool.
Excellent.
Okay. Just so people have a little bit of awareness
Sure.
of what they're getting into, you know?
Sure.
Right.
Cool. Well, so it sounds like you have a lot of things available for people to learn more about these loans, but even other things you offer over at Granite Edvance. I mean, it sounds like it's quite the operation. I mean, we've had Sean on already, and now we have you on.
Sean's great.
So it's nice that you had a chance to kind of share. Are there any other resources you have that maybe we haven't talked about that people interested might find useful?
Oh, goodness. So I mean, because we haven't touched on every single resource we've touched on aspects of what for example, our education and career pathways counselors do, but we didn't talk about everything that they can do.
Yeah.
So the best thing that I would say is if you just go to the website, just go to the Granite Edvance website, graniteadvance.org, and you can learn a lot. There's a lot of information there in general about the process, right?
Yeah.
But then you want to schedule an appointment, you can schedule an appointment online, and it will give you the option of what type of appointment are you looking for. You can do it virtually, you can do it in person. So we're located in Concord. If you're like, well, I'm not near there, and or even if you are, you're just like, I'd rather just be able to do this.
Or you're some arbitrary little town in western New Hampshire that doesn't exist.
Yeah. I never,
I don't even know where Concord is.
Yeah, so far. It's there, beyond the horizon. Because when I was doing the college counseling, we didn't have the virtual option. We really didn't start doing that until COVID came around. So, being able to reach families in North Country was a difficult thing.
Sure.
You drive down here for an hour and a half for me to tell your student, like,
you don't have to write information.
I'm not sure you're going to get into that school, but the college counseling side from the admissions advice that we can give families on the different aspects of the admissions process is fantastic. Like I said before, it was, well, maybe you saw us at your high school. Now it's like we're doing statewide webinars.
Nice.
So for example, there's a statewide webinar coming up where I just like give a 30-minute, here's what you need to know about private loan financing sort of thing.
Nice.
And so those are free resources. The other stuff, our scholarship program, this used to be a program that was $30,000 and we didn't even fund it. It was like we got donations for it.
Wow.
And a handful of kids a year got it. And it has grown from 100,000 to 300,000 to 500,000. This year was 750,000.
Wow.
So last week I was just reviewing. So Sean actually runs that or heads up that program for us in terms of the mechanics of it. And so I was just reviewing essays last week for that. We've expanded the types of students that we will award it to. It used to be just for certain levels of students. Now it's incoming students. There's like a segment that's for adult learners. There's all sorts of stuff. So there's that. We do, I said it really quickly, but I should have put a little more emphasis on it because it's a big deal. Over the past year, we've worked with the community college system and the university system of New Hampshire to set up an emergency grant fund. So non-billed expenses to the student grant fund. So think you're going to the community college and you need money to fix something with your car you can't get to class. Like we've had people, it's for food because they can't work as much, and they can apply, they can get grant funds for, $500 to help fix this or help pay for that and that sort of thing.
That's awesome.
Where your normal financial aid cannot cover any of that stuff. Right. And so we've helped fund those programs. We've partnered up with the state. So again, I'm kind of going on here, but just kind of give you a glimpse into the types of things that we're doing. So we're now partnered with the state on funding this. What's the best way to describe this? Like guidance offices, schools will use, or if they use, there's like software programs to help with like their career planning and college guidance, that sort of stuff.
Yep.
Nice.
Information about workforce and like demands, that sort of stuff. And what you'll find if you look across the state is that the cities and towns that are on the positive side of the socioeconomic spectrum, their schools have these programs, have these systems. Typically, they have one system that a lot of them all use. We partnered with the state on paying for, there's another system called Zello. We partnered on funding that so that any school in the state wants access to that, they can have it.
That's great.
By nature of us and the state funding that program. And so that's huge. We've got someone that's basically just dedicated to making schools aware that this exists. It's available for the homeschool population. But it's like, well, how do we tell them? Like, how do we get a hold of those people? Let them know, like, you can have a login to go in and use this program for free.
That's awesome.
And so that's, again, more of the kind of work that we're doing. We're heavy mission focused work right now, and how we can get into new areas that we haven't been into, have 20 minutes at a Rotary Club to tell them what we're doing so people know who we are, instead of just kind of staying in our lane of, we'll do our college presentations and people that hear about us will come to us. Like, we are so much out there more than we ever had been in the past. And so, to really kind of see it all, I'd start on the website. That's going to be the best place to start. Granite Edvance, Advance with an E. You put in an A, I don't know where it will take you, but definitely put in an E. Put in an E. And if you want to set up an appointment, you certainly can do that online.
Awesome. And that's all free, right? The appointments?
It is.
Awesome.
It is.
So cool.
Say, like, right now, the only thing we're going to charge you for is if you end up taking a loan with us.
Right,
and like any other place you take a loan, like, yes, you would have to pay the loan back. But outside of that, free service.
Wow. Awesome. Cool. Well, that's all we have for questions for you at this time.
Well, I appreciate you guys giving us the time to come down and share about who we are, what we do.
Absolutely.
Yeah, no, very informative. And as somebody who has walked through this for the last few years, it's really great information, and I kind of wish that I had known a little bit more about it back in the day. But thank you.
Yeah.
Thank you so
You're
much.
welcome.
Well, before we conclude the whole thing, we do our rapid fire segment. Are you familiar with our rapid fire segment?
I'm not, but I'm excited.
Well, this is what we do with all our guests, and it's just a fun little thing. We just ask some quick this or that questions, and you just answer.
So bad at these things.
First answer comes to mind. You don't have to explain
That's
anything.
the problem. Nothing. It's just blankness.
Well, we'll see how you do.
Right.
Okay, so coffee or tea?
Neither.
Oh, there's your answer.
Water.
Water. I like that.
Vacation or staycation?
Vacation.
TV shows or movies?
Documentary. Crime documentary.
Ooh,
Nice.
nice.
Series or movie. Don't care.
Beach or lake?
Oh. Beach.
Beach. Okay. You can say both too. Some guests
Rich is
have.
like river.
The Sugar River.
Football or basketball?
Football.
Cats or dogs?
Dogs.
That was a quick
Dogs
answer.
that eat cats.
That was.
Surfing or snowboarding?
Snowboarding. But I'd love to learn how to surf.
Well, figured you're from New Hampshire too, so you're
I
likely
do snowboard. But yes.
Are you a morning person or a night person?
Night.
Skydiving or bungee jumping?
Neither. Ground.
That was a quick answer. To
Golf.
Golf.
And pizza or burgers?
Pizza.
Pizza.
Nice.
It's not close.
Nice.
Quick answer.
That was probably the easiest rap. I thought it was going to be something where I'm like, oh man, like say the first word that comes to mind.
Oh no.
All right. Yes. The two options definitely makes it easy. Stick with that.
Yeah, we don't want to make it too hard for our guests. Awesome. Well, thank you so much again for coming on. We
You're
really
welcome.
appreciate you sharing all this information with our listeners. I'm sure that they'll get a lot. They have a lot to learn and a lot to use that's available.
Absolutely.
Excellent.
Absolutely. Thank you,
Thank
Rich.
you.
Thank you. Bye.
Bye-bye.
That wraps up this episode of the Making Money Personal podcast. If you've enjoyed today's show, we would love to hear from you. Email your thoughts about this show or any other ideas at tcupodcast@trianglecu.org. Thank you to all of our subscribers, and if you haven't yet, please hit that subscribe button wherever you listen to podcasts so you don't miss out on any new episodes or money tips. Thank you for listening, and have a great day.